Assalamualaikum warahmatullahi wabarakatuh. Hello everyone. Before that, let me introduce myself. My name is Diah Ramadhani with student registration number 234126060 from Class AKT23A, Universitas Teknokrat Indonesia. In this video, I will explain a little about investing in equity instruments in the Advanced Financial Accounting course. Equity instruments. PSAK 50, revised 2014, defines an equity instrument as any contract that provides residual rights to the assets of an entity after deducting all its liabilities. Investments in equity instruments reflect ownership of shares issued by another entity. The party issuing the shares is called the investee, while the party acquiring ownership of the shares is called the investor. Stock investment. There are various possibilities in the transaction of ownership of investee shares by investors. For example, if Company A buys shares of Company B, then there are three possible accounting treatments for three situations. If the purchase of shares by A does not have a significant influence on Company B, then A will group it as trading or available for sale securities, and its accounting treatment is subject to SAK 50 and 55, recorded at its fair value. In general, the purchase of shares below 20% is considered not to have a significant influence. The latest on investment grouping can be seen in PSAK 71. B. If the purchase of shares by A has a significant influence on Company B, then A will use the equity method to record the stock investment. For accounting treatment, see PSAK 15. C. If the purchase of shares by A is intended to control or dominate Company B, then it must prepare a consolidated report. Associated company. Paragraph 3 of PSAK 15 defines an associate as an entity, including a non-corporate entity such as a partnership, over which the investor has significant influence, and which is neither a subsidiary nor an interest in a joint venture. Cost and fair value method. Acquisition of shares that do not cause significant influence is recorded using the cost method or the fair value method. When there is no quoted price in the market, shares will be recorded using the cost method. Whereas if there is a quoted price, shares are recorded using fair value. Shares will be grouped into fair value through profit or loss. Financial assets are measured at fair value through profit or loss, or fair value through other comprehensive income. Financial assets are measured at fair value through other comprehensive income. Equity method. According to PSAK 15 Par 16, investment in associates is recorded using the equity method, except when the investment is classified as held for sale in accordance with PSAK 58. The equity method according to PSAK 15 Par 3 is an accounting method where the investment is initially recognized at cost and is subsequently adjusted for changes in the investee's net assets after the purchase of shares. The equity method is often referred to as a one-line consolidation because the consolidation of balance sheet accounts is represented in one investment in S account, while the consolidation of income statement accounts is represented by the income from S account. Allocation and amortization of differences in investment acquisition costs. In investment acquisition transactions, the consideration given, acquisition cost, may differ from the proportion of the fair value of the net assets acquired or the recorded value of equity. If there is a difference between the consideration given, acquisition price, and the value of the identifiable net assets acquired, the difference is allocated in the following manner. Allocated to various accounts whose recorded value and fair value are different. B. If there is still a difference, allocated to goodwill. The allocation of identifiable assets and liabilities taken over must be done proportionally to the percentage of ownership. If the value of the net assets acquired is greater than the consideration, negative goodwill arises and will be recognized as profit in the current year by the investor. Goodwill in the equity method does not appear in a separate account, but is in the investment in S account. Asset transfers between investors and investees. In business relationships between investors and investees, transactions often occur between investors and investees. These transactions can be in the form of buying and selling assets or services that generate profits or losses. Transactions that occur with investors as sellers and investees as buyers are referred to as upstream transactions. Conversely, if in a transaction the investee acts as the seller and the investor is the buyer, it is called a downstream transaction. PSAK 15 Par 19 states that profits or losses resulting from transactions between investors and investees upstream/downstream or from downstream/upstream, are recognized in the investor's financial statements only to the extent of the other investor's share in the associated entity. The investor's share of the associated entity's profits or losses resulting from these transactions is eliminated. Interim acquisition. If the purchase of shares is not made at the beginning of the year, then the calculation of profit from the investee and amortization of the difference between the acquisition price and the recorded value/fair value starts from the date of purchase. Investment through staged ownership. An investor may have significant influence through several stages of investment. If significant influence is obtained through staged acquisition, then adjustments must be made to the previous ownership. The investment and retained earnings accounts need to be adjusted. Sale of an equity interest. The investor discontinues the use of the equity method from the date on which the investor ceases to have significant influence over the associate, and then accounts for its remaining investment in accordance with PSAK 55. The investor measures its remaining investment in the associate at its fair value. The investor recognizes in the income statement any difference between the remaining fair value and the proceeds from the disposal of the partial interest in the associate, and the carrying amount of the investment at the date on which significant influence ceases. Stock purchases directly from the investee. If an investor buys shares directly from the company, not from the stock exchange or shareholders, then it will increase the number of shares outstanding and affect the percent of shares acquired. Investee corporation with preferred stock. If an associate issues cumulative preference shares that are held by a party other than the investor and are classified as equity, the investor calculates its share of the investee's profit or loss after adjusting for dividends on those shares, regardless of whether such dividends have been declared or not. That's a little bit of material for me, hopefully useful. If you have any questions, please write them in the comments column. I apologize if there are any wrong words. Thank you. Wabillahi tawfiq wal hidayah. Wassalamu alaikum warahmatullahi wabarakatuh.